Well, good evening, everybody, and a robust Happy New Year to all you investors. Hopefully you enjoyed 2021 as much as you possibly could. It was kind of a weird year, but the S&P 500 did come in at 27%. The value line arithmetic average came in at 26%, and anybody who experienced a piece of that or even beat it has got reason to give thanks. The tree on the screen is the Epiphany tree for our first, it's actually our last session of December, and we'll get underway in a minute. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by some very dear colleagues and long-term investors and all renowned educators on a national basis for the Modern Investment Club movement, National Association of Investors, and Better Investing. From top, and by the way, the two underneath the tree is not meant to imply any form of gift or special treatment. It's just that we didn't all fit down there. But up on the upper left, Kim Butcher from Florida by way of Evansville, Indiana. Good evening, Kim.
Good evening, guys. I hope everyone's doing well tonight.
Then our fellow raconteur investor, Ken Kavula.
My raconteur, that means I play pickleball, right, Mark? Okay.
Raconteur, that could work.
Or racketeer, I'm not sure which you're talking about here.
No,
Hi, everybody. Glad to be here this evening.
We can't go racketeer in case the SEC's listening. All right, and they could be. Third, we have Mr. Cy Lynch on, and Cy, I want to make you promise to be here a month from now when we do our award session. Actually, it'll be 2 sessions from now, but the February program is when we hand out awards, and I think you might need a wheelbarrow.
Oh, well, I will do my best to be here then. Although I may have trouble figuring out this because this is the December 2021 session, but it's 2022, isn't it? So
yeah, I mean,
is that anything like the Tokyo 2020 Olympics? Is that?
Yeah, you got it, Si.
Remember back in the day when you wrote checks and you used to get the date wrong for the first week of the year? Well, that's kind of what we're doing here. Yeah, there will be another session in January, and the award session is actually in February. But Cy is doing his best imitation of his beloved Atlanta Braves and hitting it out of the park right now, so we'll be noticing that. I say we get underway.
Sounds good, Mark.
All right, here's our standard disclaimer for those of you that are new. We do try to keep this fairly informal, but you have to realize that as we go through and we talk about real companies in real time, that no investment recommendation is intended. This is about education and illustration and demonstration of the methods, philosophies, and techniques of the Modern Investment Club movement as promulgated by Better Investing, also formerly known as the National Association of Investors, and as interpreted by us at Manifest Investing. So you're going to hear opinions from us. We're going to be talking about real companies in real time. We do try to remember to tell you if we actually hold a stake in any company that we talk about, but please do your own homework before making any investment decision. If you'd like to have an email reminder about future events, we do this monthly event. This is a monthly webcast that has been going on for 12 years. If you'd like email reminders for those events, send an email to nkavula1@comcast.net. If you'd like copies of the slides or if you have follow-up questions, Mark R at manifestinvesting.com and we'll point you in the right direction. Anything you need to add to that, Ken?
No, let's get started, Mark. I'm itching to go because we have some good stocks tonight, I'll tell you.
Yeah, and we're gonna keep it fairly succinct and celebrate the holiday season. Again, Happy New Year to everybody. This is the agenda that we've basically used since we started back in July 2010. Again, welcome if you're new to this. We basically invite the audience to participate at the end, whether you're here for the first time or here for the whatever it would be, 12 years times 12, 140th time. There's an audience poll at the end. We do keep track of how well we do. We'll talk about that. And the selections for tonight are shown there. VMware, Marine Max, Maximus, and Malibu. Being kind of an interesting little inside battle between Malibu and Marine Max because they're pretty similar situations. He will be unable to join us. There's the audience poll, and we do try to leave time for open questions and answers at the end. Quick review, we're here for a very simple purpose. That's basically to share an idea and to share some thoughts about the analysis of that investment opportunity. We do try to make them actionable. We're trying to beat the market here. We're trying to beat the market specifically with a long-term return that is 5 percentage points. That's 500 basis points if you speak that language. But we're trying to beat the market by 5 percentage points over the long term. We measure the market by the Wilshire 5000. And then we'd also like to see a majority of our selections outperform that same Wilshire 5000. Here's our results just to give some context. The relative return is very simply the answer to the question, how much are you beating the market by? You see the target line there in the middle at 5%. That is the kind of the unofficial goal of investment clubs in the modern investment club movement. They'd like to beat the market by 5 percentage points over the long term. Obviously, if you get anywhere between 0 and 5, you're still doing pretty well. And we did enjoy that little stint up near 8%. We'd like to go back there. So our situation is that since July 2010, our rate of return is 18.5%. And that's measured against a stock market, again, by the Wilshire 5000 that checks in at 14.7. So we are beating it by 3.8. That's the point that you see graphed right there. So we are trying to get back to 5%. We basically try to design this, make the selections and keep the portfolio in condition to achieve that. And that's what this is all about. Your thoughts, Ken?
Well, I'd love to see that graph moving back towards that dotted line and then north of it, but I'm still very proud of a 3.8 relative return over 11 plus years. That's not easy to do, and for us to be able to do it and to show it and to keep it public means that our patience and our discipline pay off. I'm awful glad to have help in picking stocks because I've been cold the last 12 months or so, and my not so good stock picks have been held up by some of you guys that have been real hot for the last 12 months, and I'm real pleased to have you doing that picking to keep my picks looking a little bit better than they have been.
Well, I've been cold too. So, Cy, how heavy are we, Cy?
I've been wondering why my shoulders have been so sore, but now I understand. But we all have our ups and downs, I think. So,
and Kim's been helping us out quite a bit too. So thank you,
yes.
Kim.
Yeah. Broad shoulders for all of us because we all, what is it? We all surge forward and wave on back sometimes. So with what's happening in our lives and busyness, we have probably a better stock picking and not.
Yeah, well, I'll tell you, one of the reminders that we constantly get is that it does come in cycles, and there's an ample supply of humility in the stock market. There's no doubt about it, and we'll probably hear more about that come February too.
Yeah.
But good stuff.
I had an investment club that just anytime I got too big for my hat or breeches or whatever would just say Amfesco. Which was a Puerto Rican shoe company.
I have a shoe company also, Mark. Our side, mine was called the Shoe Barn. It was an early failure in our family club, and I hear about that whenever I mention something like NVIDIA or some of the winners. I get Shoe Barn thrown right back at me. So.
Well, the things that we do as we lean on each other, there's no doubt about it. Mine was Intel, by the way. I was always challenged by, you told us to sell Intel and buy a Canadian battery technology company, which subsequently disappeared from the planet. So that didn't work out very well, but that's a story for another day. I've told it a few times before. Here's our actual portfolio. There's about 80 positions in it. These are the top 20 by percent of total assets. So you can see the number one by percent of total assets is Microsoft now. The way you would read this, again, this is a Manifest Investing dashboard displaying the key characteristics for each one of these companies. The legend up at the top provides the number of times that a company is selected. So for example, Cognizant Technology has been selected 15 times over these 10 years. You see that right here. That means that every time it was selected, either by one of us, and by the way, 14 of those 15, I believe, are Psy. Anytime it's selected by one of us or a guest damsel like Kim or the audience, we invest $1,000 in the company. So the $15,000 invested in Cognizant is now worth $33,000 and change. So you can basically go from top to bottom. One of our favorites to point out is Costco, a single time investment, $1,000 invested in Costco is right here. That's good, clean fun.
That Amazon's only a 2-time pick, Mark, and it's up there at almost 23,000. So we have a couple of those on our best list as well.
Mm-hmm. So pretty good selection of companies. We do take some pride, and there are some companies that are a little bit off the radar screen. We do very strongly believe in all of the above investing, trying to discover small, medium, and large companies. I think Sai's going to focus in on medium-sized companies in his hunt tonight. You always want to be searching for small, medium, and large. The faster-growing companies provide a lot of growth and appreciation support for the portfolio. Maximus will be chosen tonight as a repeat selection, and there's a couple others that will also be selected. So anything else jump off the page, guys?
Well, I like our some of our ones that used to be real small also, Mark, that we picked because of changing the world kind of things. Universal Display and Illumina are two of them that with only, a few picks, they've managed to stay pretty reliable and pretty good on this list as well. That Universal Display at 24,000, that's OLED, and that one hasn't been chosen a whole heck of a long number of times, 6 times. So that's a pretty good pick for that company that still isn't really well known by a lot of people, but it's one of our much smaller sized companies in the portfolio.
If you're new to the session here tonight, you can actually go to YouTube and go back a month. Ken actually presented another repeat selection of OLED and gave a pretty comprehensive update on it for us. All right, let's go ahead and keep cranking along. And this is where it gets a little bit difficult. Our success does lead to that never-ending challenge. Ken, would you like to walk us through the 35,000-foot view of the portfolio?
Well, there's all kinds of numbers on the screen here, folks. And if you're new to what we're doing, our discipline sometimes gets hidden among all the different numbers. And especially with a tracking portfolio and with as many different stocks as we actually have in the tracking portfolio, this is not the kind of portfolio you'd put together if you were with an investment club or a personal portfolio. This is tracking the choices we've made, and once we move something out of the portfolio, we freeze it at that point. We don't have real money, so we're not taking money and reinvesting it and that kind of stuff. MyPar up there in the corner, that MIPAR number, represents the average return for a stock in the Manifest Investing database. So as of this afternoon, it was about 7.5%, a little bit better. The overall market average over time is closer to 10%. So a MyPar under 10 means the market is a little bit overvalued. There's that inverse relationship there between MyPar and overvalued, undervalued. We'd like to beat the market by 5 points. So you add 5 points to the average and you get the bottom of the sweet spot, 12.6. And Mr. Nicholson, who put together the theories for a lot of what we do in the investment club movement, suggested that you shouldn't be greedy and that in order to beat the market by 10 points, you had to do almost impossible things on a regular basis. So we set the top of the sweet spot at the average plus 10. That's where the 17.6 comes from. And we'd love for our portfolio to fall somewhere between those two numbers. Obviously, if you want to raise the par value of the portfolio, and right now ours on a weighted return average is just under 10%. So what you do is you add stocks with par values higher than 9.8, and at the same time you could start to move stocks out of the portfolio that are lower than 9.8. Mark's listed 5 of the ones at the lowest end, and we'll talk about our discipline for selling those in just a moment. We'd like to keep the quality in the top quintile. That means at the 80th percentile or above. And Mr. Nicholson suggested that sales growth for the entire portfolio on a weighted basis of between 11 and maybe 12.5% should be enough to keep you in that rarefied +5 territory. Our sales growth is a little tiny bit light. We'd like to keep our sales growth at least above 11.5. So again, you raise that by buying companies that are growing faster. And if you buy companies that have their sales growing more slowly, then of course you'll lower that aggregate number right there. I go down to financial strength, which I love to see in the mid 80s or even the high 80s. 85 is an excellent financial strength number, and EPS telling us how stable the earnings are, how straight that blue line is on a stock selection guide. I like to see it around 80 or better, and I'll take one around 75. That's a reasonably straight line, and especially with what's been happening the last 2 years with COVID, we know that has impacted some of our earnings stability with companies that had to shut down and stay shut down for a period of months in the last year and a half or so. So all in all, the portfolio's in good territory. I'd like to see it back in excellent territory. And to make that happen, we need to raise our par, perhaps raise our sales growth a little bit. So look at the stocks we're choosing tonight and ask yourself, are we choosing stocks with par values at around 10 or better? And are we choosing stocks with sales growth at around 11.5% or better? And if we are, then we're moving the portfolio in the right direction.
Okay, so
Mark, why don't you? I was going to just suggest, Mark, that you cover the some of the disciplines that we have for selling stocks from the portfolio.
you just want me to talk about the selections that haven't worked out very well. A2 milk has not worked out very well. I still don't know quite what to think of it. It's probably dropped so far that it's probably too late to sell it unless you're in a cash brokerage account and could take advantage of tax-related losses. Of course, that would have been last month. So we're just continuing to watch that one and hope for a buyout by some major company or something. Ardelyx went from $9. It's now down to around $1. That did substantial damage to the portfolio last year. Jazz Pharma is also being fairly uncooperative, but that's a single position. And Ken, your Wrap Technologies did actually take a little bit of a dip also, but that's a brand new speculative entry. So we just kind of note those that they're just not working out very well. And we know that that's going to happen from time to time. And every once in a while, we'll shed some of those. The top 5 companies by lowest return forecast, lowest projected annual return are shown at the top. And again, if they're core companies, we're reluctant to let them go, even when the portfolio needs it, if they're above money market rates and of sufficient quality. So again, that's one of the reasons we hang on to Costco. It's been red hot, but the par's been pretty good. The same reason for NVIDIA we talked about last month. In fact, it went up substantially and with increased expectations actually has a higher par this month than last month. We'll talk about Cerner in a minute. The reason Cerner's up is because another company has offered to buy them. And we could let that ASGN go at any time, but that's not going to make a big difference in the par. It's one of the more challenging things we've run into with this type of a portfolio over the years. You know, what do you do with, you know, how do you make a big difference with such small positions?
Mark, I'd be willing to move Cerner out of the portfolio. I think that as long as that deal goes through, we're looking at probably the best deal we're going to look at, or maybe very close to the best deal. And I've always thought to myself that it makes sense to not let that money sit there for the next 6 or 7 or 8 months because it'll probably stay very close to that deal offer during that time. The only downside would be if somebody comes in and tries to outbid for the corporation, outbid Oracle for Cerner, and that would make the price go even higher. I doubt if that, I've seen that happen once or twice, but it's very rare. The negative possibilities are if the deal falls through, then Cerner will go back to its pre-offer price, and that's not going to be a pretty thing if that happens. And meanwhile, that $95 a share that Oracle has offered probably will stay close to Cerner's trading price until the deal closes.
Yeah, it does kind of put a ceiling on it. Cy, would that mirror what you're thinking? Same question for you, Kim.
I'd absolutely take it for me.
Yes. What? Oh, Cerner is.
Go ahead, Cy.
Yeah. Yeah. It's Cerner. Whoops. Okay. Yeah. I've heard you breaking up and thought I was interrupting too, so I hushed. Is Cerner's price today still around that 90 that this value line is showing?
It was around
90 to
93 today.
Okay, I would agree with taking the money and running. I mean, Ken succinctly set out the options, but if nobody knows of a potential bidder, that's one reason to go ahead and sell if it's close to the offer price. The other thing is if there are significant rumors of another bidder is when the market will actually bid above the market price. Let's say Cerner was selling at 100, it might be indicative that somebody thinks there's somebody on the horizon. But the fact that that's not happening, yeah, sounds like take the money and run.
Run.
And as Kim says, ka-ching.
Yeah.
That one's worked out pretty well for us. All right, so we'll definitely do that. It's trading up at a relative strength index greater than 80 because of the Oracle offer. So I think for this month, we'll just dump the Cerner and dump the ASGN. It won't make a big difference in the portfolio, but we obviously can replace it with a little bit more growth and obviously a little bit more return. So we'll go ahead and do that.
Yeah, just one thing before we move on. Ken already distinguished this from an actual managed personal or club portfolio, but I want to at least mention before we leave, if this were my personal portfolio, I would probably be also looking at perhaps selling all of these on this list, the value list, Costco through ASGN. But I would particularly on this list perhaps be considering selling Schwab because of the relatively low par and also the relatively low growth rate, and looking to replace it with higher growth and higher par to boost our par above that 9.8. Now, again, Schwab, I think Ken has put it in the portfolio. I know I have put it in the portfolio, so several of us may have. And I see no reason under just the money market rule that you mentioned to move Schwab out, but just kind of the qualification to our audience that if you're managing a portfolio that looks like these with these numbers, you do want to strongly consider selling some of these lower return stocks.
Well, what are your
And
thoughts on that?
well, are you going to talk about NVIDIA, Mark? Because that's one that I would struggle with a lot. I happen to actually own NVIDIA in a couple of portfolios, and it's a high momentum stock with a high PE and a really high growth rate. It's sitting in a lot of very innovative places within the semiconductor market, and it's done wonders price-wise. With all that being said and done, I would be sitting here trying to figure out what to do with NVIDIA. If it represented 0.2% of my portfolio, that would make it easier for me to sell it. But I'm sitting with portfolios where NVIDIA represents 10, 12, 14% of the portfolio, because I'm only looking at 15, 16, 17 stocks in some of these portfolios. And it's definitely one that I'm scratching my head about what to do about. I hate to sell high momentum stocks, but I know in the rational part of my brain that momentum can be just as strong in the downward direction as it is in the upward direction. That's a really high growth stock, though, for me to unload from a portfolio. And again, I'm focusing on sales growth.
Well, and
Well,
I was seeing that Schwab, we just added to the portfolio a year ago, maybe 14 months ago. And it's over doubled, because I think we got it at $35 or $40 a share, and now it's $89.96.
And unless we sold Schwab out, I don't think that's the only holding, Kim, because
No,
I'm pretty sure I've done Schwab several years ago, and I think Ken did before me.
Yeah, I can remember before the merger, even quite a ways before the merger, Kim. I can remember putting Schwab in the portfolio. So we'd have to go back and check the dates. It's not,
Yeah, Mark's saying 10 times.
Yeah.
Yeah, so it's a 10-time selection. It will make a bigger difference in that 9.8 number that we're trying to boost. And I don't think we're married to Schwab, and I'm with Cy. The lower growth rate.
I'd have no problem selling it at this part, Mark. The low sales growth rate, the larger percent of total makes this one an easy decision for me. And Schwab has certainly treated us very well. It's given us a real good reason to be in this situation right now. A low par usually means the stock is faring fairly well in the market.
All right, so the decision is to sell Schwab, Cerner, and ASGN. That will represent about 5% of the portfolio. So we'll see what it looks like before and after, and I'll publish that in the notes.
Sounds good, Mark.
All right, so with that, let's go ahead and jump into our stock presentations. Kim is going to kick it off with a repeat selection of VMware.
Yes, I call it VMware. Closed today at $120.50. I found this stock. It's a software, and VMware it grabbed my attention when it had a special dividend. It was announced of $27 plus. I think it was $27.50, because Dell was going to sell off the rest of the shares that they owned. And as you can see by the value line note that I have here, that it's software solutions, which enables the organizations on multiple servers to do infrastructure, networks, all kinds of stuff that makes everything reduce your spending. They're doing a lot on supply chain. So they're a software company, and they have changed their model to it's also a reoccurring revenue, because they're selling to a lot of big companies. And in doing my research, I saw where they gave the $27.50 dividend, and then I knew that the stock price would drop that much after that special dividend, which was in the 1st of December. And I was like, okay, that should be about 130. Well, you know how the market is. It gets a little overzealous, and it dropped down to like 108, and the RSI at that time was nice and low, as the way Mark has taught us to always look at that. It was down in the 30s, except we hadn't had a round table yet. So this is the first time I've been able to present that. So next slide. So they had that spinoff from Dell. They did that the 1st of November. I will admit I own these shares in my portfolio. I bought a position in it, and then once the special dividend was paid out, I then reinvested my dividends, and then I have waited to see how low would the stock go. And it hit the bottom around, I think it was December 5th or 6th. And I've been watching it since, and I wanted to make sure it would bounce back up. And I like the stock because it is a SaaS stock, or software as a service, and in that technology area, and everything is in the cloud lately. So they do a lot of things in the cloud. They do a lot of innovation. I had to look up cloud agnostic computing infrastructure, and that means that whatever their software product is, it will be able to use on any platform, whether it be a Microsoft platform or an Amazon platform. So they've got lots of growth going there. Next slide. By the way, these were all slides from their last quarterly report, and their next quarterly report will be at the end of January. The other thing I really liked on here was how much they are also in the security space, because one of the guys in my investment club told me that they knew about this stock because right now everybody has their computers at work, but then when people go home with their computers, how good is the Wi-Fi and the security systems to work into the mainframe, and they didn't want to bring anything in. So in that security space, VMware is very powerful in that. And next slide. This is the part that really got me going, is they are part of AWS, which is Amazon, and it helps them, VMware helps Amazon run their business better. So if you want to also have access to some of the profits that Amazon is having, well, VMware helps their cloud services and run their businesses, so you're getting access to that also. These here I have highlighted here are some of the latest news items that they had on their website, and they're all positive. They've got lots of research going, and they have 30%, I think, of their cash flow, which is put into R&D, and 50% of their revenue comes from the US, and the other 50% comes from international. So you have a nice international company there. Next slide. As you can see with what their products they address, it helps in customers in all different areas, and they have lots of software and licensing. I think that brought in another 22% in the last quarter. They've got lots of customer service of their management, workspace, their time horizon, their subscription and SaaS services, that grew quite well. They're firing on all fronts, very basically. So that I think is also wonderful. And their margins are like in the 25 to 30%, which is nice, fat, and juicy. Next slide. This is what happened in their latest quarter. You can see where they had total revenue growth of 11% year over year. Their subscription and license revenue grew 16%, and their license revenue, they broke it out 21%, 11%, and then RPO and their remaining performance obligations, as well as their current remaining performance obligations, are 9 and 11%. They're doing everything right. And the spinoff from Dell, they took on more debt to be able to do it, to pay out that special dividend, but they have a lot of cash flow that they'll easily be able to pay it. Next slide. Going forward on their what their revenue is going forward, they think for the year of fiscal year 2022, it'll be 7% growth year over year, and the subscription and license revenue will be 9%. So that's pretty good. Going forward, so next slide. I do like to look at some of the technicals and all this. So as I mentioned in the beginning, you can see how the stock price fell. It got down from, it had been in the 160s, and then it fell on down with what's going on when they paid it out. Your bottom hit was 108, and the stock price has been gradually creeping up. Closed today, as I said, at $120.50. Next slide. On the value line, it showed here where the spinoff will enhance, value line feels it will enhance their growth prospects over time. And the special dividend that they have to fund, that value line doesn't feel that this will be any problem. And adding it up, that recent price, which was when the value line was put out, was $163. And now it closed at 120, so it's lost $43, but they still felt back in November at a price of 163. Value Line thought it was a be of interest to long-term subscribers with a long-term horizon. Next slide. Here is the information on the proof. Ultimately, it looks like here our par can be 17.5%. even with the debt that they have and everything else. So Morningstar fair value, they think is 175. It's 120 now. So that's another 50 bucks, 55 bucks. So I hope you guys all in the audience will take this stock for your consideration.
Thanks, Kim. Yeah, they seem to be firing on all cylinders. It'll be interesting to see how those margins maintain under the new configuration. All right, let's go ahead and hit the water with Marine Max. Or I should say stay floating on the water, probably.
Well, we're looking at Marine Max, excuse me, which on first blush seems to be a direct competitor to Malibu Boats, which I've presented a couple of different times in the last 6 months. Next slide, Mark. I thought that the company did a wonderful job of telling us exactly what they do. And when you read through this paragraph, you'll notice that Marine Max is a lot more than just somebody that sells boats. Granted, selling boats is their major piece of business, but they have little pieces of business all over the recreational boat industry. And I think this paragraph here lays that out to somebody that's on first blush thinking that they're looking at just a boat seller. I did find they have a particularly decent investor presentation on their website. Some of this information is directly from that presentation. And if you're interested in Marine Max, I would urge you to look at that presentation on your way to making a decision about buying, selling, or holding. Next slide, Mark. They operate in 100 different locations in 21 states, carry 25 premium brands of boats. 6 of those brands are exclusive. They're the largest boat, yacht, and super yacht company in the world. Those are important things to remember about this particular company. Not only do they dabble in the ultra high-end boats, which they call yachts, but they dabble in a lot of the kinds of boats that you might find in a typical middle class or upper middle class neighborhood around the many different lakes and rivers in the country here. Next slide. Here's some of the brands they carry. They're not manufacturing many boats. They carry a lot of brands. They do manufacture some boats. And again, if you were to go to their web presentation, you'd get a better picture of which of the boats that, are they actually building and which of the boats are they actually handling as a dealer. A lot of these brands are familiar to me, and I'm not a boating person, so if I recognize them, I imagine you folks that are out there on the water recognize even a lot more than I do. Next slide. They get a lot of margin opportunities, and this company, if you look at this presentation, seems to really be focused on margin improvement. You're going to see that in the data that comes on the SSG, but you're also going to hear about it in various places in their presentations. They really are fixated with improving margins, and to make that happen, they're moving into areas that they didn't traditionally deal with 8 or 10 or 12 years ago. Full service marinas, for example, is upping the margins that this company is making. They're moving into helping finance the boats that they sell, and that's giving them extra margin, extra profit over what they had traditionally been dealing with. And one of the most lucrative places is this expanded parts and services part of the business. Not only are they selling the boats, but they're doing more and more with repairing and maintaining the boats that they actually do sell. So they're fixated on pulling these margins up to a place where they can be considered robust, and they're going to be a lot higher than they have traditionally been. And you can see that trend moving right through the numbers on the SSG. Next slide, please. They still make about 70% of their business in boat sales, but you can begin to see the shift in business plan, and you can see the different types of pieces that contribute to their revenues. And as you look through the fiscal years from 2015 to 2021, you'll notice the growth in these different pieces. Used boat sales has been a particular place where MarineMax has taken off and really, I think, quietly surprised itself as to how many used boats they could actually sell if they focused on that as a piece of their business, as well as selling new boats. Next slide, Mark. Here's some information from other sources. At the top of the page, you see the line coming from Manifest Investing, and I love to use Manifest as a validation of my own stock studies, and I like to use it as a provider of information on where the analyst community happens to stand on a product. And with a par of 14.1%, that certainly meets that idea of trying to buy stocks that have a higher par than 10. So the 14 I'm very pleased with. Notice the industry that Manifest, and not only Manifest, but Morningstar places MarineMax in. The little chart on the right-hand side of the slide, the specialty retailer, that's coming from Manifest, and it's telling me that MarineMax might be the top company in the specialty retail industry. And then it goes on to list a few other companies down there, which you may or may not be familiar with. And then in the bottom left-hand corner, that little paragraph is coming from Morningstar, and you'll see Morningstar also puts MarineMax into the specialty retail, the consumer cyclical sector, specialty retail industry. That's very different from where both of these sources place Malibu Boats. Places Malibu Boats in the recreational sector. That's a little bit confusing to me, but it's the kind of thing that happens when you make choices in some of these companies that deal with a lot of different kinds of services as part of their business model. So here we're looking at what Morningstar and Manifest considers to be a specialty retailer, specializing obviously in boats and things for boats. Next slide. Lines look pretty decent, especially since 2016. Nice sales growth, nice earnings growth, a little bit choppy prior to that, but definitely higher highs and higher lows as it moves into the growth territory right there. I used future sales growth of 12% for sales and 16% for earnings on my SSG. Traditionally, the earnings have grown much more quickly than the sales have, and that's that focus on raising margin that I was talking about that the company seems to have in everything that it's doing. You can see that focus begin to crystallize around 2015, 2016 when you read back in some of their older materials, and you can see that as they focus on higher margined products, they're able to grow their earnings much more quickly than they're able to grow the corresponding sales that go with those earnings. That's just simple business, and they're succeeding in what they're doing. Next slide, please. Here's that data that I was talking about, and if you focus on the evaluate management section of the SSG, that's the second set of bars on the slide right there. The first line says pre-tax profit on sales, and again, from about 2015-16, where they kind of hit a plateau of 3.5%, 4%, you can see that focus on increasing margins, moving them up in 2021 to a margin of 10%. Now that's more than a doubling of margin in 5 years. That's very difficult for a company to do. I would not expect that to happen in the next 5 years, but I would expect to see those margins continue to move upward into the 10, 11, 12, maybe even higher area as the company continues to alter its business model from being just a boat seller to selling all kinds of related services. You also notice the return on equity making the same type of move from that low in 2015, 16, 17 up to where it is today. We have return on equity going from around 7% to around 26%, going from substandard in my mind to something that's absolutely superb. And I would expect that return on equity to continue to stay at that level or perhaps get a little bit better. That's all being done with a corresponding general reduction in debt. The company is acquisitive. It's not afraid to go out and buy brands. It's not afraid to go out and buy segments of the market. But in general, you'll notice that the debt levels have been falling in a downward direction, and that's also positive for the stock. All this is being done with extremely low PE values. Look at the PEs in the high and low column from 2018 to the present time. I'm going to be able to choose a high average PE of around 12, a low average of around 4. That gives me an average PE of around 8. And if you go to the next slide, that leaves a lot of room for where Value Line thinks the average PE is going to be. If you look at that top snippet from the Value Line report, you'll see that they figured the average annual PE ratio to be around 12 going forward. I'm doing my SSG with a PE of 8. In other words, I'm giving it a very low hurdle to jump And if it jumps that hurdle, I'm going to measure its possible return. If there's a surprise, I would hope the surprise would be that they're able to jump the hurdle even a little bit higher than I anticipated. Value Line's anticipating projected earnings growth of somewhere between 11 and 25%. In their annual rates box. They're matching my sales number of 12, but again, Value Line is expecting earnings growth of somewhere in the mid-20s. I think if you look at my SSG, you'll notice that mine's somewhere in the mid-teens. So again, a low hurdle, and if there's a surprise, then it should be, I would hope, to the upside. Next slide, Mark. Here's what my SSG finally gives me. There is no dividend in this medium-sized company. All the money going right back into the company. A really nice buy at a 3.5 to 1 upside downside. A return somewhere between 14 and maybe the low 20s. And again, I'm picking a stock where the par value, that would be the 14.1, is higher than the par of the entire portfolio. And that means I'm going to try, just in a very small way, to push our numbers in our portfolio in the direction that I'd like to see them go. Again, I mentioned much earlier in the presentation, I'd like to see a higher par and I'd like to see higher sales growth. And this company will help accomplish both of those things, albeit in a very small way.
Okay. Thanks, Ken. All right, we'll give the My Boating presentation a few moments to continue warming up, and we'll go to Cy for a repeat selection of Maximus.
All right. Thank you, Mark, and thank you, Ken. I must admit that super yachts are a bit pricey for my blood, and I'm kind of afraid of getting all wet, but that might apply to you too, Mark, at least on the wet end. So
that's not doing any lobbying for votes, is it, Cy?
No, I would never,
ever
right. do that.
All right, great.
ever. But yes, I'm going to talk about Maximus tonight. You can see history for the company, generally upward trends, particularly in strong sales and earnings over the past 10 years, and relatively consistent and parallel with each other. Excuse me, next slide. This is just a quick summary of Value Line's numerical outlook. As of today, on Maximus, they're looking at potential 15% mid-range annualized return over the next 18 months, which is, of course, shorter than our outlook, but more than just the Value Line timeliness areas of good, safe, and financially strong company. And Value Line also sees decent long-term 3 to 5 year potential down there at the bottom corner of 11 to 17%, which interestingly will kind of track our high projected returns and low end of the range. Next slide. I came up with Maximus by actually running the same screen that I used last month that alerted me to Ollie's bargain basement. And you can see Ollie's is still the highest potential return on this screen. You see the criteria there on the right-hand side. The primary distinguishers from typical screens that I run and that Mark and Ken and others run, I've brought in the 52-week low criteria of within 20%, kind of looking for stocks that have been beaten up a bit, borrowing from Hugh's methodology. And notice I was focusing on mid-sized companies with 7 to 12% growth, so larger than faster growth than slow-growing large companies, but not the top of the universe as well. And so Maximus came in second on par And a couple of things that were attractive, it's about the same growth as Ollie's at a lower potential margin and gives a little bit of a projected yield. So I thought that was a good reason to look at Maximus tonight. Notice also VMware, that's in the portfolio, and Kim mentioned tonight Activision in the portfolio, Biogen as well. So there's several companies in the portfolio on this screen. Next slide. I wanted to go ahead, even though the screen had told me what medium-sized companies look like, I said, let's go ahead and look at all of the Manifest database. And you see that Malibu Boats had the highest potential return. I was using, in this case, essentially Maximus as my criteria. I looked for very high quality, 90 and above, a very high financial strength, again, 90 and above, with growth just below the 11%. And it's just a trick I do in Manifest screening that I'll mention. Notice I used 10.9. Maximus was 11. Sometimes the 11 that you see is rounded. And if you see a screen, sometimes if you do a screen right at the 11, you may not get that company, or you may miss another company that's essentially tied because of rounding. So sometimes I'll slip it just that 10th, which takes care of the rounding. I had also considered MKSI and MKS Instruments that I've done for a while, but to avoid being called the new Cognizant buyer or whatever of MKSI, I said, let's try
out of the rut.
Maximus. Exactly. There you go. It has been picked a number of times, but this is the first time I've picked Maximus. Next slide. Here's just a quick industry study. Specialty business services is the industry that they are in. And you see that it is one of the top quality companies in the industry. This ranks by quality, and it's the only company in the industry that's currently in the sweet spot for pricing and value. Next slide. This is what MMS describes itself as, innovative and impactful services for all communities. And then you see that they've worked with all levels of government, to include international right now, for over 45 years. Next slide. They have about 34,000 employees worldwide, and they're in 9 countries. The bulk of their business is done in the United States, but there you see a number of other countries that they are in. United Kingdom and Commonwealth companies, as well as Italy, Saudi Arabia, Singapore, and South Korea, and Sweden. Next slide. They had 3 basic segments. The U.S. Health and Human Services segment, which is, as it sounds, it's health and human services, again, at all levels. That's state, actually, that would be federal, state, and local health departments. They're doing a lot. For an example of what they're doing at the local level in particular, in the COVID time frame, they have been doing contact tracing and some of that back office work for local governments. U.S. Federal Services is the largest segment. That's about half of their revenues in 2020, and about 40% of their operating profit. And yes, if you're a math whiz, 70% plus 41% of profit is over 100%. But notice they are losing money in their international operations. So that's where you get the 100%. And again, on the federal basis as well as state level, they help administer Medicare, Medicaid, and various other government assistance programs. Again, they are think of them as a back office contractor for governments. Next slide. here are my judgments on Maximus. I projected about a 10% future sales growth rate. The company, as well as most analysts, are projecting the next 2 years to be quite slow, and perhaps even the first part of 2022 to be negative sales growth. That's as their kind of COVID goose that revenues got slows down and levels off, but then picking up. Value line projects about 6% over the next 3 to 5 years, but they're concentrating or focusing very much on, of course, the next 2 years. Also, MMS has made some acquisitions and does anticipate a few others. Value line doesn't take acquisitions into account. That's to be compared with the 14% historical rate, and I think the manifest consensus is about 11. Then my profit margin, which is pretty much in line with manifest consensus on a net margin basis, gives me a little over $8 in potential earnings 5 years out. Next slide. And that gives me, as I mentioned, kind of in that same range its value line had in potential return from a low, using the average PE, the par, if you will, of calculated the way Manifest calculates, using average PE of 13.7%, a little below Manifest 16.1%, and potentially as much as 17, 18%. So I'm saying let's add another $1,000 of Maximus, and if y'all happen to agree that this analysis is the best you've ever heard, you can vote to add another 1,000 as well.
Well, Cy, I don't say this too often, but at the bull session this afternoon, Mark and I both admitted that Maximus was number 2 on our list for tonight. So we almost had 3 presentations on Maximus this evening. So I'm not going to mind at all if Maximus gets all the votes, not at all.
In fact, I had to go out and redo my screening because Maximus was at the top of my screening results for tonight. Those of you that were in attendance this afternoon. Here's what I did. I basically went out and did our traditional points of view review. Basically, we're looking for the same thing that we know is always true. It's always a good thing to seek, that being excellent quality companies. And in this case, I'm going to just switch gears a little bit and talk about a double-digit projected return on value. Again, that's going to generally compare pretty much to the projected annual return, so don't lose any sleep over that. I'm just looking for companies where the projected return on value is fairly formidable, in addition to being above 90 for a quality ranking. So you see a pretty good set of companies. In fact, tonight I would have been very tempted to go with Steel Dynamics if Morningstar hadn't disagreed with me. What you're seeing in these grade infields is just the ones that just were not setting the world on fire. So I'm just kind of winnowing things down by pointing out the ones that have either too low of a return or just, you know, not enough muster there to really keep my attention. You'll see a number. There's a few companies on there that are on our best small companies list, but the ones that kind of bubbled to the top, Malibu Boats, to go head to head with Ken's, a selection of that high-end boating company, and Malibu isn't quite as high, but they are nice, and they are very good at what they do. As you can see, reading from left to right, pretty good projected return on value, decent relative strength index right in the middle. Value line sees an 11% return, and then I find that the analysts, both Morningstar and the analyst consensus, both think that it's considerably on sale, and they actually look for as much as a 37% return over the next year. So that one kind of bubbled to the top for me. There's some other good studies in here too. We've talked in the past about America's Car Mart, which might not be a bad area to at least dabble with a little bit. DuPont is intriguing. And as we talked a little bit this afternoon, Borg Warner is also a little bit compelling also. So there are some studies there that you might want to take a closer look at. Medifast and Green Tree are in the best small companies portfolio. Again, this is a company that has been selected. It was presented by Charlene at the recent Successful Investing Conference. It's been selected here by Ken for the roundtable, so it is a repeat selection. Again, not good products, but not quite as high end as what Ken was talking about, but these things are everywhere, fresh water and salt water, and that's basically what we're talking about. I wanted to share this slide just to point out that these are the 20 companies that are in our best small companies list. The reason I share it is, you know, one of the questions you ask yourself when a company is lagging a bit, and the companies down here are lagging a bit. Oops. Let me back up here for a second. The companies down here at the bottom are lagging a little bit. You want to kind of pay some attention to the ones at the lower part of the chart and ask yourself the question, are they damaged? Do they have, you know, really nagging problems, or is it simply a buying opportunity? And for a number of those companies down there at the bottom, including Malibu Boats, I think it's probably more an opportunity than a real nightmare unfolding. So I would do the shopping at the bottom down there. Boston Beer would have been my second or third pick also for tonight. I presented that a couple of months ago. Here's what it basically looks like. Again, the top line is very strong. You can see that the sales have been very consistent, tracking at about that 11% level that we talked about. We want to find companies that are in that range for the portfolio when they're on sale. And this one tends to look pretty good. The operating margin for this company has been very, very consistent. That's what's basically graphed here and shown in a percentage basis down below. You can see that 2021 was actually a pretty good year. Some might call that the stimmy bump. Many people believe that the stimulus packages actually had impact on businesses like Malibu Boats. In fact, I can point to tweets on Twitter where people were talking about taking their stimulus payments and basically causing this to happen, believe it or not. So you're basically looking at a pretty good situation with respect to profitability and top line. You can see the earnings down here. Again, here's your bump up with the stimulus packages, but from left to right, not too bad of a picture. So with a growth rate of 10, projected operating margin around 20, that basically equates to a net margin of about 14. The PE is only 15. They don't pay a dividend, but this does result in a stock that's in the 14 to 15% for the projected annual return. Very high quality, very limited number of liabilities, decent amount of cash on hand. We do like it when the projected annual return and the projected return on value actually align, and in this case they do. You can see this is actually fairly important. Even though they have relatively low debt, it's very important to notice that if they do need money, banks are willing to loan it to them at an attractive rate. That says a lot about the financial strength of the company. Much like Cy was talking about, we're looking at a situation where the company is actually trading relatively close to its 52-week low. It has been lagging since we added it to the list back around Halloween. You can see that the opinion from Value Line is for a long-term forecast of 105 for the low end of the spectrum, and again, an 11% return. And you can see that Morningstar checks in with concurrence that this company would be fairly valued at 100. So if it's at a current value of 68, so it's at a discounted value of as much as 30% to its fair value. So I say let's throw another log on the Malibu Boats fire, and basically stuck at the nominations that have been made in the past and contributed by Charlene during the Successful Investing Conference, Charlene Hansen. And I believe her investment club may have actually accumulated some Malibu Boats recently. So let's go ahead and run the poll, Ken.
Okay, give me just a second here, Mark.
We apologize for the late start tonight, people. The internet and go to webinars.
Here we go.
Bit. So is Len Douglas here voting twice?
I didn't notice, Mark. We have a nice attendance this evening, and we'll try to get maybe 85–90% of those voting. Voting's already up to 60% of the audience. If you're brand new, just take your mouse or your finger or however your computer works and choose one of these stocks. Doesn't cost you anything. We will not only put $1,000 into each of the choices we've made, but we'll put an extra 1,000 into the audience favorite as well. And Len has answered, as he always does, and he said that it's just the Surface Studio. I did not mean to type Malibu Boots. I did mean to type Malibu Boats. So that's my fat fingers doing a terrible job of typing, even though I read it back to myself. I read it as boats, even though I typed boots.
So we have clear grounds for an appeal, right, Si?
Yes, you do. All right.
That's right.
Okay, and we're up to, let's just get another couple folks voting here. We can push it over 90 maybe.
Yeah, come on, folks. I haven't said anything about voting for my stock then where, everyone else is pumping their stock up. So that last couple votes, how about mine?
I'm going to close the poll, and I'm going to share the results. And we are going to put an extra 1,000 into Maximus. Malibu and Marine Max split the vote. 17 for Malibu, 18 for Marine Max, and VMware came in at 30%, came awfully close to the Maximus, but not quite. So we'll put an extra 1,000 in on Maximus. And since Si has been so hot, I'm going to go back to my personal portfolio and add some more to Maximus as well, I think.
That's a lot of pressure, Si.
My shoulders are drooping from the weight.
I own it already, Si. So you're not giving me a new position, but I'm
just going to add
a little bit. Going to add to it, yeah. Okay, Mark, I'm going to hide the poll and turn it back to you.
Okay, are you showing the screen now?
I should be, yeah.
Okay. Just a quick reminder that we do archive all of these sessions on YouTube. Just search for Manifest Investing Roundtable, and you'll definitely find this page. We do archive the monthly roundtables. You can see some of them over there on the right, the more colorful ones, including planes, trains, and automobiles down at the bottom down here. Those are roundtables from previous months. We also archive the weekly bull sessions that we hold on Tuesdays at 2, and other sessions such as the Successful Investing conference that we completed just a little over a month ago. By the way, if you want to listen to that Malibu Boats presentation, the comprehensive one by Charlene Hansen, go here and check that one out. And if you want to check out the foundations of that list I showed, the best small companies, go here. That's from right around Halloween. And those are available to you. If you subscribe and you actually hit this button, we will notify you anytime new content is added, and we greatly appreciate your support. So with that, just a few events coming up. Ken, we need to talk about some events when we get offline here, coming up here in the spring, and we'll add them to the list for next. Actually, the January roundtable will happen at the end of this month, January 25th. So we'll hopefully expand this list out, and you see the February roundtable listed there. I'll put together a little workshop webcast for this coming Saturday to talk about some of the Tin Cup and various Sweet 16, et cetera, at Manifest Investing. Anything you'd like to add to that?
Well, Mark, we only have one question from Cheryl, and I'd like to aim it at Kim. Kim, Cheryl would like to know, do you have a source of where you can find an advance notice of special dividends?
I have seen it in Investors Business Daily that they have it there, and I happened to be at a friend's house who had the Investors Business Daily there, and I saw it. Any place else, I just sometimes, I do a lot of reading, and I saw it there. So I do know that Investors Business Daily will have a list of special dividends.
Thanks a lot. And that's the only question. I've been able to keep up with the questions pretty closely as we go through here, Mark. So I'm going to wish everybody a happy new year and remind you that our regular January roundtable will be on the last Tuesday, and hope to see some of you there. We had a really nice audience this evening, and maybe we can duplicate it again at the end of January. So happy new year, guys.
Happy New Year to you. Everybody get out there and buy some Malibu boats.
Good night, everybody.
Good night, everybody. Happy New Year. Thanks.
Here.